What's up, millennials? Today we're going to be taking a look at the valuation of a company called Sharecare. This is a digital healthcare platform, and the company is going to be acquired by a SPAC that's currently trading under the ticker symbol FCAC. Now, before we start, if at any moment you don't really know what I'm talking about, please check out my full SPAC guide that I released a few weeks ago. The link is going to be somewhere in the description. Today we're going to be taking a look at the method number 2 of this SPAC guide. Also, if you need access to the Excel sheet I'm going to be using today, you can join our Discord for free to get it. If you go to nesami.com/discord, then you can leave your name, leave your email address, and you're going to get access to it. And of course, as always, don't trust me, verify me. Always check what I'm doing. I'm just documenting my journey here on YouTube. I'm certainly not a financial advisor. Don't copy my numbers as is, but come up with your own multiples, your own numbers to see what you believe is a fair price per share for this company. Sharecare is a digital healthcare platform, as I've already mentioned. It's a little bit like a smaller version of Teladoc, if you know that company. They already have a very solid amount of revenue. They have this proven track record that I'm currently looking for. So it's definitely one of the safer SPACs out there, I would say. With regards to the merger date, we don't have any fixed date just yet, but it's likely going to be closing somewhere in Q2 of this year. If we then take a look at the pro forma valuation of this company, we can see that they started out trading at $10 per share, as is very common with SPACs. And we can also see that if you add up all of these shares and subtract the amount of the shares that are going to be sold in a secondary sale, you're going to arrive at 415.1 million shares outstanding after the merger, which is going to give you a market cap, a pro forma market cap of, well, 10 times that, because if you multiply that amount of shares by $10 per share, you're going to arrive at a pro forma market cap of a little bit more than $4.1 billion. We can also see they're going to have $401 million in cash on their balance sheet. So if you take that market cap we just calculated, subtract the amount of net cash, then you're going to arrive at an enterprise value, a pro forma enterprise value of almost $3.8 billion. Thing is, however, if we go into trading view, we can see that pre-market this SPAC currently is trading at $10.10 per share. So that's the number you can plug in over here. It's not going to change a lot because it just has gone up with 1%, of course. So yeah, the pro forma market cap is still 4.2 billion more or less, and the pro forma enterprise value still is more or less 3.8 billion. But we, of course, would like to know what a fair enterprise value is, what a fair price per share is. Well, for that fair enterprise value, we are going to take a very simple formula. We are going to be taking a look at the revenue of a certain year, and for this video, we're going to be taking a look at the revenue of 2021, and we're going to apply a certain multiple to that revenue to arrive at a fair enterprise value. So we need two numbers. We need that revenue of 2022, and we also need a fair range of multiples. Let's first take a look at the revenue of 2021. Actually, I might have said 2022 before, but I mean 2021. So as we can see in the investor presentation, we can see that in 2021, they expect, and of course, as I say in almost all my videos, expect is a large word, but I do kind of think that this SPAC might be a little bit on the safer end compared to many other SPACs out there. Anyways, they expect to have $396 million in revenue in 2021. So that's the number you can plug over here in your Excel sheet. That's the first number we are going to be using. And then we're also going to need a fair range of multiples. For that, we're going to go to this page over here in the investor presentation. We're going to be taking a look at the numbers of 2021. So these numbers over here, 2021 EV to revenue multiples. And then we can see that currently, based on a price per share of $10 per share, Sharecare has a multiple of 9.5x. Because again, yeah, 396 million, as we just saw, multiplied by 9.5 is almost 3.8 billion rather, which is of course very close to that enterprise value we have just been taking a look at in the previous pro forma valuation of this company. So Fariel, 9.5x, is that actually a fair multiple? Is that maybe too high? Is that maybe too low? Well, we're going to be comparing this multiple to other companies out there in the same sector. We have here, I believe, 5 companies, Amwell, Teladoc, Frisia, Accolade, and One Medical. We could see a range of multiples going from 15.5x on the low end to 25.7x on the high end. And the median number, basically the number in the middle, is 18.3x. So that could actually be a nice indication for a fair range of multiples for a company in this sector. I believe what I've come up with is a range of multiples of 16x on the low end and 20x on the high end. So those are the numbers you can plug in over here in your Excel sheet. And then basically the Excel sheet is going to take care of all the calculations for you. What it's going to do is going to take that revenue of 2021, which was $396 million, and it's going to first of all multiply that by 16 and then also by 20 to arrive at these enterprise values. So for the low end, if you multiply 16 by this number, you get this enterprise value of a little bit more than $6.3 billion. If you take the high multiple of 20x, you're going to arrive at an enterprise value of 7.9x. And then you can also say, all right, let's then take a look at what the average midpoint enterprise valuation is, which is basically the average between this number, and that is going to be $7.1 billion. But that is, of course, the enterprise value. We want to know what a fair price per share is going to be. For that, first we need to go back to a fair market cap. How do we do that? Well, in the beginning of this video, we said that the difference between a market cap and an enterprise value is the amount of net cash they are going to have on their balance sheet. We said that was going to be $401 million. So if you take those enterprise valuations, add back the amount of net cash they are going to have on their balance sheet, you arrive at these fair market caps. So for the low end, 6.7 billion, for the midpoint valuation, 7.5 billion, for the high valuation, 8.3 billion. And then the only thing you need to do is to take those market caps, divide them by the amount of outstanding shares, which we said was 415.1 million shares outstanding after the merger. And then you're going to arrive at these fair prices per share. So for the low valuation, $16.23, for the midpoint valuation, $18.14, and for the high valuation, $20.05. So based on these calculations, Sharecare is likely undervalued right now. But of course, don't trust me, verify me, always check what I'm doing, always check if the calculations are actually correct. And also take into account, we have been taking a look at assumptions. We've taken a look at a predicted revenue number of 2021. We've applied a certain range of multiples. Maybe you believe the range of multiples should be lower, maybe it should be higher. That's up to you, of course. But do keep in mind that if you change one of these variables, the entire calculation is going to change and your fair price per share is going to change as well. With that being said, thank you very much for taking the time to watch this video, and I hope to see you in the next one. Bye bye!